Welcome back. Here with Money, Money, Money. And this week we are discussing the fine print of mutual fund investing. What are the rules and regulations you should be aware of? And what are your rights as a mutual fund investor? Feroze, now let's talk about a scenario where an asset management company is bought over by another company. So what happens then? I mean, all the schemes directly move to the buyer, and then therefore if I am one of the investors, I also have to migrate?
There are different situations where promoter holdings can change. One is a takeover, complete change of name. The other is a merger between two asset management companies to form one of them, and then they co-collaborate and use the names and the brands. And the third is where one of the partners or one of the owners or a promoter is increasing or decreasing his stake. In either of these cases, the investor's rights change dramatically during this transition phase, of 30 days. So all these three situations require some degree of vigilance in this transition phase for an investor across a couple of items. So I think it's an important aspect which you're bringing up.
So take us through the fine print. What happens in each case then?
So in all the three cases, one right you get is that you can exit any of the schemes invested in any of the two AMCs if they're being merged, or in one of the AMCs which is being taken over, without an exit load. Generally, most schemes today, at least 80-85% of the schemes which are not liquid schemes have an exit load in which you invest. Equity schemes have an exit load of 1 year. Debt schemes have an exit load of 3 years, more or less. There could be exceptions though. If you've just spent 2 years and you have 1 more year to go in a debt scheme, and if there is actually a promoter holding change due to merger, takeover, or an increase or decrease in sale, you get an exit-free exit from that scheme. So you can actually move out of underperforming schemes in case a takeover merger happens without paying the exit load. That's one. So that's worked wonders for people because, and this is not a very rare phenomena, because at any point in time, every financial year over the last 3-4 financial years, at least 3 to 4 asset management companies have gone through this process.
That's a very interesting point. Speaking of exits, there are exit loads, as you mentioned, which are still in play. There are no entry loads. They have been banned by the regulator quite a few years back, right? So is there any other sort of charge that one needs to be aware of when it comes to mutual funds?
Yes, I think very importantly, this is a fine print which little do people know, that August 2009 is when entry load was actually abolished. Since entry load was abolished, the entry loads are not to be taken. But systematic investment plans, which is the most popular method of investing in mutual funds, where an individual invests on a monthly basis, SIPs or systematic investment plans, any systematic investment plan which was started before August 2009 is still attracting an entry load today.
So if you're paying your monthly investment limit for an SIP which started before 2009, you're still paying an entry load to the AMC.
Absolutely.
Wow, that's an amazing insight that I don't know if all people would be aware of.
Correct. SIP is a very recurring long-term investment plan. So it quite happens that you've made an SIP commitment in 2005 and
you've forgotten about it because it was part of your ELSS planning, and maybe it's just continuing without much of a thought.
Correct. So anybody who has a 20,000 rupee SIP in the last 6 years has lost out 60,000 rupees because of entry loads, because he's doing 20,000 rupees every month.
And what is the charge that's being levied? How big is this entry load on these
2.25%.
Okay, so the previous rate of 2.25% continues.
So it's
what's the option now? What's the solution then?
The solution is you will have to once actually give a closure to your systematic investment plan and reinstate in the same scheme. If you like the scheme, you can continue investing in the same scheme, but doing extra documentation, if it can save you 5,000-6,000 rupees a year on cost, which is very, very good. I think just 1 degree of documentation one time, closing the old SIP and reinstating it will actually do the trick.
Extremely important. So if you've got any pre-2009 SIPs, please go back, take a look, and you might want to make the changes that Feroze is recommending. Feroze, very quick last point, expense ratios. The basic management fee that an AMC is, of course, entitled to charge. Simple question here that Are they fairly reasonable, and are they fairly uniform across the different asset management houses, and how do they vary between equity and debt schemes?
See, expense ratios actually are quite diverse. And if you look at equity category, as the scheme becomes bigger, the expense ratio chargeable permitted by the regulator reduces significantly. So small schemes are more expensive generally, and the large schemes are cheaper. Okay, some asset management companies publish their expense ratios including service tax, and some don't. So you'll have to be very careful when you're comparing two expense ratios, because it could be apples and orange comparison, because 15% difference could be there due to service tax
and with service tax. Yeah.
So when you're comparing expense ratios of all asset management companies, please you'll have to check whether it includes service tax. Half of them actually include service tax and half of them don't.
But generally you're saying rule of thumb that the bigger the scheme, the bigger the size of the fund, typically lesser the expense ratio.
Yes, because the regulator actually puts a cap on how much you can charge beyond a certain threshold of assets collected. The first few crores is the most expensive, and then the scheme becomes a 10,000 crore scheme, then you have a lesser expense automatically, which is clamped down by the regulator itself.
And this would apply to both equity, this basic thumb rule of bigger the fund, lesser the expense ratio, this would apply to equity and debt funds?
Not necessarily, because most often than not, the limit of debt funds expense ratio is never utilized, because there's very little scope for expense in a debt scheme, because 9.5%, 8% is the return, right? So expenses generally are very, even a small scheme could be significantly lower on expense than a bigger scheme in the debt side.
All right, fair enough. Lots of interesting points coming up over there. We'll take a break, but on the other side, again, a very important element. What happens if you've forgotten about an investment and an old folio number suddenly comes to you? How do you go about claiming all of those forgotten investments, those forgotten dividends? We'll talk about that on the other side of the break.